What's going on here?
If you want to know what's really going on in crypto, you have to look at the exchanges. The trouble is, most exchanges are private and don't exactly share their secrets. But a select few are publicly traded, meaning they're required to open their books, and one of the biggest of them just dropped an earnings report packed with revealing insights into the state of the crypto market. So today we'll unpack those earnings, highlight the biggest surprises, and tell you exactly what they mean for crypto. My name is Guy, and unlike that altcoin pic your uncle just dropped into the family group chat, this video is something you do want in your life. Okay, first things first, you need to know that nothing in this video is financial advice. It's educational content intended to inform you about Coinbase's recent earnings report. If you want to make sure you get more content like this, then smash that like button, subscribe to the channel, and ping that notification bell. Now, for those who aren't already familiar, here is a quick refresher on Coinbase. Founded in 2012 by Brian Armstrong and Fred Ursum, Coinbase is one of the largest cryptocurrency exchanges in the United States and in the top 10 globally. While Fred stepped away in 2017, Brian remained as CEO, steering Coinbase into its current position as one of crypto's leading trading platforms. Now, Coinbase has earned its massive popularity primarily through ease of use. With approximately 8.7 million monthly transacting users, Coinbase's simple user interface makes it particularly accessible, especially compared to many exchanges with clunky and complex interfaces. But Coinbase isn't just an exchange. It's a diversified crypto powerhouse with numerous revenue streams. Its primary income source is transaction fees, which are higher than most competitors for two reasons. First, the simplicity and convenience of its platform justify higher fees for many users. And second, Coinbase is committed to regulatory compliance, spending significant resources on adhering to ever-evolving crypto regulations. And of course, this translates to higher fees for end users. But transaction fees are not Coinbase's only moneymaker. It also generates revenue through subscriptions and services such as Coinbase One Basic, a subscription plan offering benefits like zero trading fees and access to the forthcoming Coinbase One card. Then there's Coinbase Earn, its staking platform, which generates revenue through staking fees. Coinbase Wallet also contributes to the bottom line through smaller indirect fees. But these are just the tip of the iceberg. Custodial services are another key revenue stream, with the platform managing over $245 billion in crypto assets, including those held for institutional clients and crypto-backed ETFs. And if you're wondering how to invest in those ETFs, then be sure to check out our dedicated video right over here. Now, we also can't overlook Coinbase's lucrative partnership with Circle, the issuer of the USDC stablecoin. For those unfamiliar, Coinbase originally had a 50-50 partnership with Circle, sharing management of USDC until August 2021. That's when Coinbase handed full control over to Circle, but still kept a share of the revenue generated from the reserves backing USDC, along with an equity stake in Circle itself. These USDC reserves primarily consist of government bonds, which earn steady interest, around 5% annually, effectively generating passive income. In fact, in Q2 this year alone, Coinbase earned roughly $332.5 million from this reserve arrangement. Coinbase also holds around 8.5 million shares in Circle, valued at approximately $1.6 billion. And that's not all. Coinbase's very own blockchain, Base, is also rapidly gaining traction. Built as an Ethereum Layer 2, Base offers near-instant transactions on Ethereum at fractions of a cent. Since launching last year, Base has already seen over $12 billion worth of assets moved on-chain, and it's consistently processing billions in monthly transactions, which makes it one of the most successful of the many, many Layer 2s out there. All right, now that we've covered how Coinbase makes its money, let's dive into what analysts were anticipating from Coinbase's Q2 performance. Heading into Coinbase's earnings, analysts were somewhat divided, caught between declining trading volumes and growing revenue from subscriptions and services. The general consensus from FactSet expected Coinbase to report around $1.59 billion in total revenue and earnings per share of $1.25, down notably from the roughly $2 billion earned in Q1 but still above the $1.45 billion reported a year ago. But some, such as Barclays analyst Benjamin Buddish, had a more cautious outlook. He anticipated Coinbase's transaction revenue would fall short of expectations due to declining retail trading activity. He came to this expectation by comparing Coinbase's retail trading activity to data from Robinhood, and noticed that Robinhood's retail trading volumes dropped by about 43% from the previous quarter. Interestingly though, despite his caution around the immediate performance, Buddish actually raised his price target significantly for Coinbase's stock from $202 up to $359. He justified this increase due to Coinbase's recent stock re-rating, driven by legislative optimism around the Genius and Clarity Acts, though he maintained his neutral rating. Other analysts were more optimistic, like Citi analyst Peter Christensen, who maintained a bullish stance, significantly raising his price target for Coinbase to $505 and reaffirming his buy rating. Christensen highlighted Coinbase's recent addition to the S&P 500 index, along with clear legislative advancements such as the signing of the Genius Act on stablecoins and strong momentum behind the Clarity Act. He argued that Coinbase is well positioned to capitalize on the ongoing shift and predicted long-term upside from Coinbase's stablecoin business, increased utilization of the base chain, and the growth in subscriptions like Coinbase One. JP Morgan analyst Kenneth Worthington was one of the many analysts who took a more balanced outlook, though. He maintained a neutral rating with a more modest price target of $404. Worthington acknowledged Coinbase's robust position in stablecoins, particularly its lucrative arrangement with Circle, but remained wary due to potential regulatory uncertainties, compliance costs, and the lingering impact of a significant cybersecurity breach that took place back in May. All told then, while analysts were divided heading into Coinbase's earnings, one thing was clear. With estimates like these being discussed, the sentiment around Coinbase and crypto more broadly was, and still arguably is, firmly in bullish territory. And if you want to take advantage of this, then you'll need to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashback on deposits of up to 75% on crypto exchanges. These deals won't be around for long though, so take advantage of them ASAP using the link down below or the QR code on screen. Now, Coinbase officially released its Q2 earnings in a detailed shareholder letter published on the 31st of July, and there is plenty to unpack. Starting with headline figures, Coinbase generated $1.5 billion in total revenue during the quarter, representing a 26% drop compared to Q1. This decrease was primarily due to lower transaction revenue, which fell sharply by 39% quarter over quarter, totaling $764 million. According to Coinbase, this decline was related to significantly reduced crypto volatility and lower trading activity, particularly from retail customers. Specifically, total trading volume on Coinbase plunged by about 40% quarter over quarter, falling to $237 billion. Within this figure, consumer trading volume dropped even more severely, down 45% to $43 billion, partly reflecting Coinbase's deliberate adjustment to stablecoin trading fees implemented in March. Interestingly, Coinbase pointed out that much of the decline in transaction revenue resulted directly from lower stablecoin pair trading due to these pricing adjustments. Meanwhile, institutional trading volume fell by 38% to $194 billion, closely tracking overall market conditions. Beyond the headline revenue numbers, though, Coinbase's subscription and services segment offered relative stability. Subscription and services revenue totaled $656 million, marking a modest 6% quarter-over-quarter decline. The standout performer here was stablecoin revenue, specifically from USDC, which increased by 12% to $332 million. This growth was driven by higher average USDC balances held by users, increasing 13% quarter-over-quarter to $13.8 billion, as Coinbase continued to successfully attract and retain stablecoin deposits through targeted incentive programs. However, other subscription and service revenues, such as blockchain rewards from staking, experienced a noticeable decline, dropping 26% quarter over quarter to $145 million. Coinbase explained that this decline was primarily due to lower average asset prices for ETH and SOL, as well as reduced protocol reward rates. Interest and financing fee income also fell slightly, down 6% to $59 million, although this was partially offset by record high balances in Coinbase's prime financing business, driven by growing demand from institutional clients like corporates, hedge funds, and crypto miners. Meanwhile, Coinbase's custody business hit an impressive milestone, with assets under custody reaching an all-time high of $245.7 billion, representing more than 7% of the total crypto market cap. In fact, Coinbase remains the dominant custody provider for crypto ETFs, holding more than 80% of Bitcoin and Ethereum ETF assets in the United States. Now, one critical challenge that Coinbase faced in Q2 was the widely publicized cybersecurity breach reported in May, which I noted earlier. This incident resulted in significant one-time expenses totaling $307 million, primarily related to customer reimbursements and legal fees. Consequently, total operating expenses rose by 15% quarter over quarter to approximately $1.5 billion, primarily because of this event. Excluding these extraordinary costs, Coinbase actually managed to decrease its operating expenses in key areas, though, such as general and administrative, down 10%, and sales and marketing, down 4%. Conversely, technology and development expenses increased slightly, up 9%. Despite these challenges, though, Coinbase still reported a notably high net income of $1.4 billion, substantially boosted by significant unrealized gains. This included a sizable $1.5 billion unrealized gain from Coinbase's investment in Circle, as well as a $362 million unrealized gain from its crypto asset portfolio. All told then, Coinbase's adjusted net income, which excludes one-time gains or unusual expenses to better reflect core profitability, stood at a modest but positive $33 million. However, beyond the earning figures, Coinbase has made progress in other areas. It made substantial progress with its base chain, which continued gaining rapid adoption, achieving lightning-fast transaction speeds, now measured in milliseconds, and transaction costs as low as fractions of a cent. Additionally, Coinbase unveiled the new Base app, an integrated on-chain platform for social interactions, trading, and payments, attracting over 700,000 sign-ups on its waitlist shortly after beta launch. Coinbase also continued expanding its consumer offerings with products like Coinbase One, introducing a more affordable subscription tier to attract new retail customers, and announcing the Coinbase One card powered by American Express, which offers subscribers up to 4% cashback in Bitcoin. Now, having said all that, while Coinbase's core profitability wasn't exactly stellar this quarter, the bigger picture isn't overly gloomy, especially given the significant expenses tied to the data breach. But what about Coinbase's outlook for Q3? Well, the shareholder letter offered investors a cautiously optimistic roadmap, highlighting expectations for recovering revenues and strategic expansion in the upcoming quarter. Starting with transaction revenues, Coinbase estimates a modest recovery for July, forecasting roughly $360 million in revenue, an improvement compared to the monthly average from Q2. Subscriptions and services revenue is projected to rebound more significantly, landing somewhere between $665 million and $745 million. This recovery is expected to be driven primarily by higher average crypto prices. Additionally, Coinbase expects stablecoin revenue to grow further, particularly given that USDC's market capitalization reached all-time highs in July. However, it's not all sunshine and roses. Expenses are also expected to rise. Coinbase projects technology and development costs, along with general and administrative expenses, will increase to between $800 million and $850 million. This uptick is mainly due to significant headcount growth planned for Q3, supporting international expansion, increased regulatory action, and continued innovation in new product initiatives. Sales and marketing expenses are similarly forecast to increase, expected to range between $190 million and $290 million. The higher end of this range reflects Coinbase's readiness to scale up marketing efforts, particularly if market conditions remain favorable. Specifically, Coinbase highlights that these expenses could vary significantly based on two main factors: opportunities in performance marketing, which tend to correlate closely with crypto market volatility, and increases in USDC balances held by customers, which directly impact reward payouts and related costs. On the strategic front, meanwhile, Coinbase is preparing for the completion of its acquisition of Deribit, a crypto options and derivatives exchange expected to close by December 2025, which would expand Coinbase's derivatives product suite, enhance its international presence, and provide a steadier revenue stream from options trading. Now, with all these big and impressive numbers on the table, what does all of this mean for the broader crypto market? Well, there are several key takeaways that give us a sense of the crypto landscape over the next few months. First, Coinbase's Q2 results clearly reflect a transitional period for the crypto market. Transaction volumes fell sharply, particularly among retail traders, but subscription services and stablecoin adoption showed resilience. This underscores an important shift. While speculative retail activity has slowed down, genuine use cases like payments, staking, and stablecoins are steadily increasing. This kind of foundational growth sets the stage for a healthier, more sustainable crypto ecosystem long term. Another major factor here is Coinbase's bullishness on crypto adoption, especially reflected in its strategic investments and expansions. Base, its aforementioned Layer 2 chain, has become a crucial part of its growth strategy, consistently increasing adoption and proving that there is consistent demand for scalable, low-cost blockchains, even when markets are down. Additionally, Coinbase's partnerships, like those with Shopify and Stripe, enabling widespread USDC payments, highlight that crypto is steadily making inroads into everyday commerce. Meanwhile, on the regulatory front, things have arguably never looked better. The passage of the Genius Act created clear guidelines for stablecoins, and the Clarity Act will establish a comprehensive market structure for digital assets, effectively removing the regulatory uncertainty that's burdened the industry for far too long. Considering how uncertain things were just a year ago, it's no surprise Coinbase is now confidently planning its expansion. But while these fundamental developments paint a positive picture, we can't ignore the current market turbulence. Crypto experienced a sharp pullback starting in late July, aligning closely with broader financial markets like the S&P 500, which of course sent investor sentiment plunging. But if we zoom out, July was actually a strong month overall, with BTC gaining around 10%, ETH surging an impressive 55%, and even smaller cap altcoins seeing significant increases in some cases. This strong performance sets the stage for potential upside once the market shakes off the current correction. On the macro front, the Fed is expected to cut interest rates by 25 basis points in September, potentially giving markets an extra boost. But even if that doesn't happen, crypto markets don't necessarily need rate cuts or a return to quantitative easing or QE in order to rally. For instance, back in 2017, during one of crypto's most explosive rallies, especially in altcoins, the Fed was actively raising interest rates and pursuing quantitative tightening, yet crypto still managed to surge significantly. We saw the same in early 2024, when Fed rates were at multi-decade highs and QT was in full force. So clearly there's more to the macro. As far as we can tell, what truly drives crypto prices is liquidity, investor confidence, and attention. Now, even without direct intervention from the Fed, other factors like bond buybacks by the US Treasury or stablecoin issuers purchasing bonds can boost macro liquidity. And the recent crypto-friendly legislative clarity may provide precisely the certainty and attention needed to fuel a significant rally. And last but not least, traditional finance giants like Charles Schwab entering the crypto trading arena further validates crypto's growing legitimacy. Rather than a threat, such moves are strong indicators that crypto adoption is reaching mainstream finance, which again could translate into more liquidity, investment, and broader acceptance in the future. So, while market conditions may still be tricky, especially for those holding altcoins, the future for crypto has arguably never looked brighter. So, Have patience, keep the faith.
Enjoy the ride.
And if you're curious about how the worlds of TradFi and crypto are merging through tokenized stocks, then you'll definitely want to check out our dedicated video on that right over here. And if you haven't subscribed to the channel yet, then you can do so right over here. Okay, thank you so much for watching, and I'll see you again very soon. This is Guy, signing off.